Hey everyone, this is 11.9 and I just got a question about coin. So this is going to be a lesson, not a trade recommendation. This is not a trade recommendation. I'm answering a question, but I'm taking the opportunity to teach a lesson about options, specifically a call calendar. I've done this before. I shared it with Teladoc, but it was the exact opposite setup where Teladoc had already fallen into a pit. So from the chart perspective, coin is not an obvious point of entry. I liked it when everybody hated it, and I shared longs that played out very well. Up here, I would never chase a stock when it just came into a prior massive fail. This is not an obvious point of entry. I wouldn't even touch it until it comes back here. That's personal preference. But today is not a trade recommendation. I'm simply making a comment on the chart itself before I delve into the options. So the setup that they asked for, because they liked the call calendar, and I'll explain what that is to on the call side. So they are betting up tomorrow. So I'm here to tell you that the move tomorrow is completely a coin flip. So if you want to know what it's going to do tomorrow, flip your coin 3 times and take the average of that and then do the opposite, and maybe you will be right. It doesn't matter what report they deliver. It's what people are expecting, what you're expecting, what I'm expecting, what 100 people like you or me or different than you or me are expecting, and that's what drives it. Somebody said, well, machine control the action. Yes, but they're programmed by people, and they're programming them to react to certain words, like miss on earnings, and it's usually misestimates. Who cares? The goal of making money with companies is to beat last year, to improve. So if they beat last year and kill it, yet they miss somebody's asinine estimate, yet they punish the stock 20-30%. That's what happened with PayPal. They missed the estimate by 0.7%. They guided lower by a small fraction, I think. They improved sales 16 or 17%. Nobody pays attention to the fact that they're improving. They all focus on, oh my God, they missed the estimate. So this is different. Let's see what we can set up. Again, this is not my trade recommendation. I'm going to say it like 1,000 times, so be ready. This is me answering a question and teaching a lesson about call calendars. So this is Coinbase, coin. They specifically said, I want to take advantage of the implied volatility for this week. This contract has 3 days on it. It expires this Friday. Today is Tuesday. So here's what happens. The implied volatility shoots through the roof, this one. 125%. What is this? It's how nervous the markets are about this contract today. Tomorrow, the nervousness will disappear if they report tonight. I haven't checked. So once they report, which I think is overnight, this number should come into go back into reality. So let me see if I can show. Sometimes this shows it. Look, this is what it normally is. The implied volatility. This is what it is today. Tomorrow, it will go down to here. Or here somewhere. So all this nervousness at the open, if price doesn't move, if I buy a call, I'm going to lose half of it. 40 to 60% of it is just going to disappear just because the stock opened. Say it doesn't move a penny, I'm going to lose half my money. So buying this contract is ridiculous. You would need to be so lucky to make money. So not for me. So what they're asking, hey, let's put in play where we can leverage this. So if we know that this is too expensive, we go buy something that's less expensive. So the December contract is half. Look. So the premium here is half. So they want to buy this contract and sell this contract against it. So if you buy, by the way, these are not my trade. I would never pay $3,000 for one contract. That is not me. Without a real trade. Like if it's an active trade that just broke out and I'm chasing it minute to minute, I would, but not on a coin flip overnight. I would never do that, ever. I don't have any edge overnight. If you think you do, you're wrong. You're 1,000% wrong. You're as wrong as me using 1,000%. There is no way you can predict the next. You'd be lucky. You can predict it on luck. That's it. So let's say I buy this one. It costs $3,100, but that's the normal cost for it. If I come and sell this one against it, so I want to sell one, I sell this one here, and that would be this week's contract, 355. This one. So let's show you a visual. Let's see fewer. so we can put them all in one window. So I'm buying this one in December, 38 days. I'm selling this one 3 days. This one is twice as expensive as it should be. So tomorrow, this one should get shellacked unless price runs through it, but even then it's going to lose a lot. So that's the idea. This is not the trade I would do, by the way, because I want to leave room for it to pop tomorrow so it dies. The idea is for it to die its natural death. So I would want it up here. Okay, so that's for starters. So if I want to keep it a calendar, I would need to bring that one up here too. Or a little bit lower, 375. So now I no longer have a calendar. I have a diagonal. Let me share why. So I bought the 375 call, not me, him. 375 call, paid $2,400, and they sold the 380 call for this week and collected $900. So they reduced their entry. The stock can pop. This can die for its maximum life, which would be best for us, whoever does this. And they'd be left long this one, $800, $900 cheaper than they would have. So, ideal scenario for this. Tomorrow the stock pops and stops at 380 this week. This dies for zero. They're left long this one for $2,300 minus $900. That's their cost. $2,400 minus $900. That's their cost for it to rally for the next couple of weeks, and then they're really making money. So that's called a diagonal. I buy one out in time. I sell one at the week calendar or higher, turn it into diagonal. So if I did this, that's called the calendar. Why? Because I buy the 375, I sell the 375. It's just calendar. I'm using calendar differences. November 12th, December. If I use different calendars, but also raise it, not lower it, raise it. You could lower it, but then you create undue risk. You raise it a little bit, you make it into a diagonal. Literally, you're going diagonally, not just laterally, but you're going up diagonally. So that's called the diagonal. This is what they're asking for. This is not my trade. Wow. I'm watching the markets. Anyway, this is the fourth bull trap today. That hasn't happened since September. Be careful, folks. Okay, so the point of this lesson is just pay attention to the time difference. So this can be done using next week, would be cheaper, much cheaper, but less time on the clock. So if I change this one to be next week, so by November's contract, this one, it would be a lot cheaper because it's only $1,300 to buy the 375, $900. So now I'm only spending $425. This is a bet I can swallow. Like, okay, $400 per contract. Maybe somebody knows something and they're lucky, but still, this one is still expensive, 90. So this one will also lose tomorrow. So if I go to 2 weeks out, 70. Now we're back in line. So probably this is a smarter one. 2 weeks out. So the 26th, and it would look like this. Still, buy the 375. They would buy the 375, call, sell the 380, call against it. So they don't have risk. If the price shoots to 1 million, they're short at 380, but they're also long at 375. So they're not in danger of being like unlimited losses, like shorting a call naked. All right, so that's it for now. This is a short-term a short lesson on what a diagonal, what a call calendar is. This stuff works on the put side as well, but they specifically asked for the setup, and I'm specifically answering them with a video and leveraging it and sharing it across the system for us. Again, not my trade setup. I am not trading Coinbase